Hi, this is the final lesson, the one on my models, and first of all I want to do an introduction. So these are not models that are used by themselves. You can. My suggestion is building your approach on this. You can choose a few that you like, one that you particularly resonates with, and build your approach on it like I did. So my approach is more structured, but the foundation and most of the time my entries are based on these models. Then, second point, these are all time-based models, so they are not price patterns like a simple market structure shift with a free value gap. They are not like this. They are time-based specific models, and now that I will explain this, I will also talk about like a little the narrative that you want to find, the bias, the general context in which these models works best. The only one that isn't time-based model is model number 2, the last one, and you will see why. But it's easy to blend it with time. Some of these models are fractal, some of these are specific to one time frame, and some of these also work best in Forex, and others are universal to all markets, and I'll explain why regarding to every models. Then, last thing, this will be mostly by my choice, a theoretical lesson, so I will draw just so you can understand the basics of the model, the why, and then my suggestion and homework, if you wish so, is to go back in time into your charts and see this model by yourself. Do screenshot of them, of the one you like, obviously. Do screenshot, keep it in a journal, in your computer, your phone, whatever you want, and look at that by yourself. If you want, you can send me also some photo and I will comment that. But if you see this logic in price action and you resonate with it, then you need to view it, to find in price action the model by yourself, because that's the way you learned. So I will show you a schematic logic and also speaking about in which condition the model works best, and then the work of finding it in price action is to you. So let's begin. So the first basic one, this is also another one I forgot to say, not time-based, but it's easy, and I will tell you why. It's easy to blend it with time of the candle you are trading. So the first model is classic range model, and probably you already know that, but I will touch a bit on some gems about this. So let's assume you have a clear and defined range. Okay, so you have a range defined clearly where price is not breaking this. Now you have what? A range high, a range low, and an equilibrium price points. And an equilibrium. And the way I already told you this, to verify the equilibrium, it's seeing the respect of price, of this price level. And so you have these three not subjective price points. a range high, a range low, and an equilibrium. Now, this model is a controller model, so you are engaging price exclusively at the high, the low, and the equilibrium. Yes, the equilibrium too, because one type of entry is price manipulates down into the range low. You buy this with a clear invalidation, and invalidation can be either an intermediate term low, in this case to the left. You wait for a change in state of delivery, or you go to the blind entry. Either way, you buy the range low, partial 50% of the left at the 50% of the range, usually witness a retracement, and then you take price to the other portion, the other end of the range. Easy. So that's the main entry of this model. Obviously, reverse in a sell case, and there are clear rules. Range, enter in the total soup, partial at 50%, partial on the other way. I use that sometimes when there are clear ranging market profiles. Then I'm mostly interested in buying or selling at the range extremes. Obviously, if there is a monthly range, okay, like many monthly candles that are in a range, then I can trade the lower time frames like the daily, weekly easily. So it depends on what you're trading, but the logic is this. Then the second type of entry, and this is far more advanced, is both, and this is the gem, is both for false breakout, so the beginning of the Judas that led to the turtle soup, or for if you are bullish and you are expecting price to be bullish, but you are not witnessing a bullish turtle soup of the range low, you can enter for the true breakout of the range. This is a little more advanced, but it's the same. So usually at 50% you will witness a turtle soup at the 50% of a previous liquidity pool, and the true breakout with the retest of the range high. So in this case, case number one, turtle soup to the 50% and the opposing end. Case number two is entry at 50% more advanced if you are expecting a true breakout, and target range high and potentially beyond. Second entry or pyramid, you can pyramid at the retest of the range high. You can find example. I traded one on Ethereum of this. Finally, at the 50% fairly advanced entry is turtle soup at 50% to bring us to an extremity, and if you're bullish, this is the turtle soup that will lead to the breakout. So this is an entry if you are able to anticipate this with ideally a key level above, okay? So this can be a weekly candle, a daily candle, open, rally. This is how you blend this with time. Open, rally from the open, higher time frame, key level. Judas, remember, you want to say this taken to then go up. So you are done by this low of the week. If this is like Tuesday, Monday, Tuesday low of the week, enter to the weekly expansion. But so there are two, you can engage price only at range low, 50% and range high, either as a retest, as a turtle soup, as a false movement. So this is model number one with clear and defined rules, and obviously you can use, if you choose that this is the only thing you trade, obviously there won't be as many setups, because you need to wait for a ranging market profile to happen, so you miss on the expansion phase. But that's a model sometimes I use. Then the other one, more that gives you more setups, not every week but most of the week, is the classic Monday range model. So we have monthly candle. Okay, so well, let's do like this. So completely, okay, you have monthly candle. Let me save this. Okay, so you have monthly candle bullish. Let's assume you have a week. Okay, you have a monthly candle, then you have, so sorry, Monday candle, then we have Tuesday, and these are all models that I use, remember. Then you have Tuesday, and then finally Wednesday, and this is also connected to another model that I will explain. So the Monday range model is a three candle model of a specific time frame, and okay, basically it's, you have Monday low and high, and 50% of the Monday is a specific type of the range trading model. It's not the same, because the range trading model is a actual range that builds up liquidity. This is a candle range. It's different. So you have a Monday low, Monday high, and you take, obviously with context, otherwise it will be a pattern. So with context you will take Monday from low to high directly, and this is how you trade partially the weekly range expansion, because for this model, that's what everybody doesn't talk about. Romeo said this, but taking it with a low profile, so not everybody understand. To trade this model, it's not the same as a range model, because that's based on market profile. This is based on weekly candle power of 3. So you basically you are basically trying to, and that's one of my this is one of my favorite model. You are basically trying to catch a portion of the weekly expansion. And what's the beauty about that? That if the weekly candle is open Monday, this is Monday, then Tuesday, then Wednesday to the Monday high, then you're done by this. But you may be wrong, and this is not a expansion candle, but it's a doji. So maybe after taking out Monday high, price will reverse for Tuesday, and then Wednesday, Friday, small range day. But the model is the same. So Tuesday, it's or Wednesday, ideally Tuesday. So ideally Wednesday reach Monday high, and usually Tuesday it's a higher time frame PDRA and the reverse. Okay, so you trade like from here, turtle soup, to here, Monday range high, and you're taking the movement into a doji candle. So the candle will look something like this, and you are still able to trade this weekly candle. That's the beauty. I made a mess. One moment. Okay. So taking in mind this, on the lower time frames, it will look something like this. So Monday creates a range, an expansion, then closes maybe here. Okay. Tuesday opens, usually it's a doji, so go down, smack into higher time frame key level, and closes near the open. Then Wednesday, drop down from midnight opening price, and then rally expanding to Monday high, and finally closes. So how you trade this model? You can, if you have, first of all, you need to develop a weekly bias, a weekly clear direction, and if you can anticipate either the shape of the weekly candle is best. So how do you anticipate the shape? Well, after an expansion, consolidation is needed, and also keeping in mind the time, so the time aspect, so which week of the month it is. As you know, usually the first and fourth week of the month are low range, small range weekly candle. So you anticipate, you will develop a weekly bias, a weekly expectation. Then you drop down to the daily. You ideally find a key level here. In this case, Tuesday should create the low of the week for the model to be valid, and you can enter either in Tuesday low, so the turtle soup, so the low of the week, you can enter here. You can enter directly with an invalidation on the left. You can wait for your pattern to develop here below the opening price of the day, end of the weekly candle. Or you can wait, let candle number 2, so Tuesday, develop, and wait for Wednesday to distribute, and potentially sometimes even Tuesday, to distribute price, so enter just below the open, to Monday high. So that's the type of entry you can do. Candle number 2, my favorite, or candle number 3 below the opening, or phases of reaccumulation within the distribution. Okay. Now, why didn't I say take partial at Monday 50%? I never do that, simply because I want to. Now, Romeo throw this model on Twitter and on his private mentorship without context. So Monday taking 250% and high. Now, I never take partial at 50% because I do not trade pattern. I want to have a clear expectation for the weekly candle. If I don't have an idea, a directional idea for the weekly candle, I don't trade this. If I know that the weekly chart is trending higher, potentially towards a higher time frame liquidity pool, this week I'm bullish, then I can confidently buy with a defined risk Tuesday soup and hold until Monday high, reversed from bearish case scenario. So you understand, it's a different approach. The first step is the weekly bias for this model, and then you trade this. Then we coming to the same logic, but fractal. So if you wish to have more trade frequency, you can do this instead of the Monday range model. You can trade the Asian range model. So same thing. Now, there isn't a specific candle for the Asian range model, but I said it in the past, you also remember the, and sorry, one last thing, for the Monday range model, if the expansion for the weekly candle is up, usually Monday high is retested and it becomes a key level. Also, you see order block, so that's why order block retested, go up. I said that because it's the same thing from the Asian range, and you saw me actually executing on the retest of the Asian range. So the Asian range model is like this. Asia is from 20 to midnight. So let's do like this. So if you do a screenshot, you have all the info. So it's from 20 fuck it. Okay, so Asia is from 20 to midnight. Why? Because most of the time, if you go back in your chart, you'll see a spike in volatility at 20, so 8 p.m. New York time. So that's the Asian session, and I say Asian range because this work, obviously, I wanna say the Monday range model is universal to all markets. The Asian range model is for Forex and especially, always, only for Western currency like the euro, euro dollar, pound dollar, USD CAD. Why? Because if you trade US like USD JPY, usually the Asian session is really active because it's a JPY. Same for USD NZD, AUD USD. They are like very active in that session because in that part of the world, yeah, you understand. So if the Asian session is an expansion, then you don't trade this model. You wanna see some kind of range to form. So that's why it works best on Forex because London is active, and especially on euro, pound, CAD, Canadian dollar, and all of this. So you wanna see a Asian from a low high. So you take what? You take the higher low and the lower high, the higher high and the lower low, sorry, in this period of time, and that's become your Asian range. Now you can extend it and do whatever you want, but how do you trade this model? It's a pattern? No, because now there is the Asian range pattern. If you can find it online, it's not an ICT concept, or it's a pattern historically known. So one side to the other side. That pattern was back tested, and the results are like just above like 51-52% of win rate with a 10 pip stop loss. Why? Because every single pattern without logic and context lead to nothing, to break even. With a 1-to-1 was the test. How do I trade this? Same thing for the Monday range model. I need to have a clear directional bias and for the daily candle. So if I'm expecting the daily candle to deliver to the upside and be bullish, I come to the charts at almost at 7 usually, my time, so it's 1 a.m. But I trade after midnight. This model happens only if I see a clear and defined Asian range, more or so. It shouldn't be perfect. It can be also like this, but not a straight expansion. So I come to the charts, and if I'm bullish on the daily range, I wait for what? A purge of the Asian low and then a distribution to the other side, potentially using the Asian high later on as a support level. So that's how I do it. And you saw, if you scroll back in my Twitter feed, you will saw that my entry on Euro, I missed the soup because I was at sleep, and I come to the charts around 6, and at 6 a.m. my entry was on the retest of the Asian range. So that's the model. Obviously, if you are bullish for the daily candle, you wait for a purge, and like there is I back tested it in the past, like 1 year ago, there is like 81% of probability that London, if it is a classic buy daily candle, will purge Asian low. If it is a classic sell, 81% that it will purge Asian high in London. Ideally at 3 a.m. It can be between 1 and 4. The ideal time is between 1 and 4 a.m. So you can trade in this model. What are your entries? Same thing. Enter in the soup itself, my favorite, and not the third. Or wait for the retest of the Asian high. Now, same thing inverted. So if you are bearish for the day, you wait for a purge of Asia high above midnight opening price. So same thing above midnight, a purge of Asia high, and you bring this to the other side of the Asia range. Your model can be just this. So you will be done from here to here. Your model can be also, and that's what I said, you can build upon this. You can be also, this is your entry for the high of the day, in this case. You take a partial at the Asia low, and you hold until London close for Forex, until towards the end of the daily candle. You can trade like this, so this can be your model. I'm just giving you ideas. In that trade, I enter here and I hold for the daily close. So it's another approach. So this is the Asian range model. So I have explained the classic range model, the Monday range model, the Asian range model. Now it is a bit different. It's the next day's model. And I want to give credit to this for the name, at least, because now our trade this model is different. But for the name, I take the name by the MMX trader. However, my approach is not only different but extremely more refined, because the knowledge of time is on another level. So same thing for this model is. In some cases, like the Monday range model, but it does not have the same rules. So, and it's more versatile. It's a logic here, and that's spoiler. That's how I trade daily ranges. Okay, I use this model to trade daily ranges. Otherwise, I do not participate in them. So, for this model, you need to wait. First of all, develop a weekly bias, weekly expectation. So weekly directional bias, and yeah, same thing. Once you have developed that, you stick to that and you wait for the high or low of the week to form. So if you are bullish on the weekly candle, let's say, this is Sunday open, okay? You wait for you skip Monday, you wait, you ideally mark off a daily key level, because usually it's what will mark out the low high of the day. So in this case, you are bullish for the weekly candle, okay? You are aiming at a drawn liquidity above or whatever. You mark a daily key level, so the block, FVG, volume imbalance, breaker, whatever you want. You wait for price to hit the key level and to form the low or high of the week, and you let the day closes, okay? So let's say this is Monday, and this is Tuesday. You wait for Tuesday to close. So the low of the week is already put in at a higher time frame key level in line with your expectation. Then what do? You trade the next day, so Wednesday, and it is an incredibly high probability of being a high low of the day. Not only Wednesday, pay attention, the day after the low of the week is formed. And I say that I show you later. So in this case, Monday, Tuesday, Wednesday is a classic sell, and you trade this day. So same thing, you can use Asian range model to enter. It's fractal, so midnight open, buy below at ideally total support key level, whatever you want, and you trade this day because it will be, with an extremely high probability, a classic buy day. Now, why I said that not Wednesday, but the day after the low or high of the week is formed? Because if you are familiar, and you should be, with the weekly profiles, I use 4 of them. So the weekly profile I know and use and I see repeating over and over again are the following. Fuck your shorts or long inversed. So Monday low and or keep running towards the week. You have an example on GU some weeks ago. Then we have classic buy, so Monday, Tuesday, Thursday, okay? Then you have a mid-week reversal, so drop from the open, Wednesday hit a key level and reverse. And then finally you have a consolidation, Tuesday reversal. So consolidation throughout the week, Tuesday drop, taking out the range low into a key level, and Friday is a classic buy. Now, you need to be familiar with these weekly profiles. Why? Because in every instances, you will have some days available to trade with this model. So, in Fuck Your Shorts, you wait for Monday, you skip Monday, you see that Monday was already at a key level and formed the higher low of the week. Then you trade Tuesday, Wednesday, and Thursday as classic buy. Example, some weeks ago on GU. Classic buy-sell profile. You wait Monday, Tuesday hit the key level, you wait for the candle to close and confirm. You trade Wednesday as a classic buy, not Thursday, because it will be the cap. So only Wednesday in this occasion. Midweek reversal. You wait, Wednesday hit the key level. This week, past week on EU, clear example. and I called it live on Twitter. So you wait for Wednesday to hit the key level, form the low of the week. Wednesday close, you trade Tuesday as a classic buy. Only this. In the last case, you skip all the days until Tuesday, create the high low of the week, closes, and you trade Friday as a classic buy. All reversed from bearish cases. So now write notes of this, because you will know which trades, which days to take a trade, a potential trade. So time before price. So if the week opens, wrong tool. If the week opens on Wednesday, drop down, Wednesday creates the low of the week, like in last week on you wait Wednesday to close, and you trade what? Tuesday as a classic buy candle. Then in the last week on Friday was a chop. So you are trading the highest probability day regarding the weekly profiles that unfolds in this week. So you develop a weekly bias, you mark a key level, you try to understand which weekly profile is unfolding, and then you trade the highest probability day/days of that week. Usually is only one. Usually, unless it's a straight line toward the week. In that case, there are like 2 days you can trade, like a classic buy-sell candle, daily candle. That's one of my favorite approach to trade the daily range, and I trade only the daily range after the higher low of the week is formed. So I use all this model, not by themselves, but together. Next, we have the 1 a.m. model, and this is one of my friend's model. So I'm not inventing it, it's Villa. I don't know if you know Just Villa on Twitter. He is one of the best of my student from the beginning of 2023. And he trades only, exclusively 1 a.m. candle of one asset, GBP, JPY. Now, the 1 a.m. candle, you can trade it on which pair do you want. I don't suggest indices, because obviously they are more active towards the New York session, but on Forex it works perfectly. So 1 a.m. model, what does it mean? Well, usually it works hand in hand with the Asia. So if you have a clear expectation for the daily candle, then look for Asia low or rise. It will be easy. You can trade this model even if you don't have a clear bias for the day. You should only develop a bias for the session, so for the 4-hour 1 a.m. candle. So is this candle more likely to expand higher towards a 1-hour FEG, something towards Asia high, towards that liquidity pool, is more likely to expand downwards? Then, so creating the bias for the 1 a.m. candle, you have 1 a.m. opening time, 1 a.m. closing time, so 5 a.m. And then you treat the candle watching its profile. So if the candle opens, consolidate a bit and drops into a key level, like a 15-minute FEG, because it's a 4-hour candle, a 15-minute FEG, 1 hour router block, something like this, on which time 1:30, then it will be a classic buy sell, a classic buy. So on which time 1:30, 1:30, okay, not random, this is 1:30. If instead it reaches your key level, your anticipated higher time frame key level, at the midpoint in time of the candle, it will be a doji, a pin bar, and the midpoint of between 1 and 5 is 3 a.m. So your entries should be always within this model at 2 times, either near 1:30 or near 3. Otherwise, it will be a choppy candle, so avoid trading it. Just a suggestion, if you don't trust me, go see yourself. The highest probability 1 a.m. candle forms the low either at 1:30 or 3. After this, so this is one model, you choose one specific candle and you trade only that. You are content and you close the trade at the end of the candle. So you are entering at the low and you're closing near the end duration. Another model is the 9 a.m. and it's the same exact model, the same. So you have ideally classic buy, sell, and so reach the key level. What did I do? At in this case classic buy sell, because it reaches your anticipated higher time frame level at what time? 9:30. So it's the 9 a.m. candle, 9 to 13, and the key level, if it reaches around 9:30, it's a classic buy sell. Otherwise, it will be reached towards the 11, because it's the midpoint in time of the, it's ugly, destroying, it's really ugly. Okay, better. So if it reaches the key level at the midpoint in time, 11 o'clock, then it will be a pin bar. Every other times it's low probability. And I said why not the 5 a.m. candle model? Because the 1 and 9 are the highest probability candles to trade, for our candles to trade. 1 because it's London, and 9 because it's New York session. Now, with the 9 a.m. model, you can trade it on Forex, like Euro USD, GBP USD are very likely. Or if you are really getting pip drunk and catching crazy moves, indices for this model usually offer like a crazy expansion. And if you become really good to anticipate with this model, you can catch crazy moves, because usually the 9 a.m. candle on indices, on S&P 500 and Nasdaq, forms 80% of the daily range. So if you enter with a 5-minute stop loss and at 9:30 usually, or 11, and target the entire daily range within a 9 a.m. candle, one trade a week can retire you. Finally, we have a generic model, so a model that works on every time frame you want to trade: monthly candle, weekly candle, daily candle, 4-hour candle, 1-hour candle, and it's a model that Romel spoke about. And his intent, he chatted with me and others on the chat group, and his intent was to spoon-fed as much as he can people, because on Secrets of Time he didn't give a 1, 2, 3 model, a simple model for the lazy ones, for the dumb people. So he did it on on UTS, he decided to create what? Model number 1 plus. And the plus is for the not so dumb people. Model number 1 only is for the dumbest people I know. Because it's, I mean, if you trade only this, yeah, like you have a 60% win rate, maybe. With a 1-to-1, I'm saying. Because if you are to increase without context your RR, then you are fucked. But model number 1 plus is it acknowledges also time, and so if you use it like I'm told, like I'm telling you now, then you are likely to succeed, and this can become your entry model because it is an entry model rather. So it works within every candle, model number 1 plus. So choose a candle you want to trade. Anticipate your that candle bias, so the most likely direction and shape of that candle. Once you have that, so let's say you want to trade a monthly candle. You are bullish for that monthly candle. You wait for without time-based ranges, without projection, without it's really simple. So monthly opening time. If you are bullish for this month, you are waiting for a drop below an old low. So well, let's draw it like this. You are waiting for not necessarily before the opening time, so I will do both cases. You're waiting for a drop below an old low, close above. So a drop below an old low using this, the candle on the 4-hour time frame. On the time frame you are trading the candle, so monthly 4 hour. On the 4-hour time frame you are waiting for that specific candle that stabbed into the low to be closed above, and that becomes your model 1. Why is model 1 plus? Because you are incorporating the aspect of time to trade a specific candle. Okay. Now, obviously, and I explained this to you, if you blend time-based ranges, if you blend higher time frame key levels, if you blend time of week, so day of week, time of day, higher time frame context, and all of this, then your win rate will increase massively. But if you want to keep it extremely simple, then are you bullish or bearish for the next candle? Okay, bullish. Then I'm waiting for opening time, a drop below the opening price of the candle I'm trading, a stab into the low, a close above the candle that stabbed into a previous low, and rally. Now, this, and that's what I was saying, the low can be also after the opening time, so it can be like this, so open, creating a low, a stab into the low, and then rally. And this is then your model 1. Okay. Reverse all of this if you are bearish, obviously. So same thing, the low can be also, and this for the monthly candle can be like week 1, week 2, but keeping extremely simple, it's bullish, buy below the open at your order block, so model 1. Bearish for the candle you are willing to trade, sell above the open after the model 1, so the candle that stabbed into a previous low above the opening price and close below is created. That can be a really simple model and a working model, because if you focus on the bias for the higher time frame candle, and then you are looking essentially for a lower time frame pattern below or above the opening price, it's a great model, in my opinion. If you trade it like this, because you implement logic and narrative to this. Finally, an amazing model that is not necessarily time-based, but you can blend it with time easily, and that is not spoken a lot. Romeo said that, and it's great in my opinion, and it's really easy. It blends Earl to Earl concepts with the turtle soup, and you can add the time like the range, the classic range model. So essentially is fuck it. Okay, so essentially it's one moment. I'm drawing the key to this model, the key PDR base. Okay, so a higher time frames gap is a lower time frame turtle soup, and that's model number 2. Scroll back to the Twitter feed and you'll see this. So higher time frame gap, fair value gap, is a lower time frame liquidity pool, and so a lower time frame turtle soup. So essentially on the lower time frame you will see this. So well, let's making this little above, and on the lower time frame you will see like a rolling, something like this, and then something like this. So a lower time frame gaps, a higher time frame gap, and this is the gap view on the lower time frames. Okay, is a lower time frame turtle soup. So you blend in this case pre-manipulation liquidity pool with the higher time frame key level in one, and you are trading this with a lower time frame risk to higher time frame reward. So essentially what you are doing, and this trade, by the way, is the exact model that Romeo uses 2 days ago on JU. The last trade he posted where he said CRT is this model. So it was a daily bearish fair value gap on JU. The day it was Wednesday pre-CPI, London of Wednesday, smack into that bearish daily FVG. It sold there and it sold there and waited for the daily range to develop. So it's a model that occurs more often than you think. You can use a daily gap with a daily candle. So daily gap, you trade a daily candle. The same gap you traded, that's how you blend it with time. You traded the same candle, time frame candle. So in this case, you will trade not sorry, I messed up. So in this case, you would have traded the, let's do like this. The daily candle if it was a daily gap, the monthly candle if it was a monthly gap, the weekly candle for a weekly gap, and there is an example on euro, the last bearish run of the last year. Weekly gap, beautiful weekly delivery. Daily gap, beautiful daily delivery. 4 hour gap, beautiful 4 hour delivery. So you already, in this case, in this model, it's easy because you already know which key level you're looking for. It's not subjective, it's that one. The liquidity pool, it's the liquidity of the gap. And so you are essentially breaking down this candle. So the opening time of the candle you're trading, if it is a daily midnight with a daily gap, drop below, you enter here, okay, with a stop either at an intermediate term high or low on the left that you trust, or you wait for a lower time frame change in state of delivery, or you go with a blind stop like I do sometimes. So you enter here at the gap and you can target obviously the high that broke the low, or wait for the, like I do always, for the range of the candle to play out. So in this case, look higher time frame view, lower time frame view. This is model number 2, also very simple and effective, I would say. Maybe if you're trading daily gaps, so daily candle, you have one trade per week, and you can increase that by having a basket of asset. So maybe yes, NAS, euro, GBP, so pound dollar, USD CAD, you can have a basket. This can be just your model. You trade daily FVG for the daily range, and you will find that you will have a crazy win rate because a same time frame key level will have will produce high probability swings on the lower time frame that is used to see that candle time frame. So in this case, daily key level, 15-minute high probability swing. Weekly key level, 1 hour high probability swing. Monthly key level, 4 hour high probability swing. So with this, I conclude the lesson, and now you understand why I didn't show you example of every model, because the lesson will would have been like 2 hours. So it was a long one, but and the final one. So I hope you enjoy, and let me know if you have questions or everything. And once you figure out your model / approach, I would also love to know what is, so just for curiosity. I mean, you started knowing nothing or knowing a little, and I hope that with this journey your trading, your knowledge of the charts have improved. And if you come to the conclusion that you want to trade in a specific way, some specific time frames, waiting for something specific to happen, I would love to know what it is, just for curiosity. So wishing you a good rest of the weekend, and see you.